Ma'am,
Yes, Kavya.
there is some construction work going on here. I'll be unmuting myself, or else we will not be able to record it properly.
No problem, no problem. Let's continue with the next topic. The other day, 5 days class, we've learned about price elasticity of supply. So after that, let's look at the next topic, which is market failure. What is market failure? The concept of market failure is explained as the inability of a market. Until now, we were discussing about whatever is the demand from the customers, demand, and the ability of the supplier to supply the material as supply. So now here in this case, when is it called a failure? Failure would be when the market is unable to allocate resources in a way that maximizes utility. So if they are unable to supply the material or supply the goods, then that can be referred to as market failure. So now when the market is not able to provide the resources that are needed when there is demand, but the supply is not there. In such situations, we see that government would intervene. Um, so government can then have a role to intervene to ensure that market functions effectively. See, supply demand, these aspects are subject to the price fluctuations, price changes. See, when there's a lot of supply, there is an impact on the price. See, lot of availability of material. So uh, the price would be very low because lot of availability is there. Then when they cut down on the supply, the price gradually increases, etc. Then the demand, when it is high, the price is low. The demand falls down. Then the price rises. See, subject to there is an impact there on the price, and that would have an impact on the profitability of the supplier or the supplier. So in that case, when they cut down on the supply part of it, then their profit would be maximized. But there are certain other goods which are to be provided irrespective of what is the profitability scenario. So government ensures that such kind of products are supplied to the customers uninterrupted. So some of them are given here. What are the different types of goods that are to be supplied? So we see first merit goods. Then we see public goods. Then we see demerit goods. Then there is a concept of negative externalities, and large company abuse their market power. So what are the problems which we see? The first type of it is merit goods. So there's an example given for merit goods. It says that merit goods like healthcare may not be bought by consumers either through choice. They don't have a choice, but see, they are dependent on that, or they cannot afford the price. As the uh, they have to buy that, so the demand is there for these kind of goods. When they have to buy that, is it okay? The supplier charges any price to that. Okay. Now, if the supplier charges any price for these merit goods, then the customer will not be able to. But there is a need here, essential here. There is a need that they are dependent on merit goods. So in such situation, government intervenes here. State provision of education, healthcare, and affordable housing. So there are certain limits which are set. See, it is not subject to at what point it would be equilibrium or what price is the best price for the supplier. Irrespective of that, there is government's intervention. Maybe government gives some subsidies or grants to the suppliers, so the supplier does not charge that high price, and whereby the dependents or the consumers who are dependent on these kind of products do not suffer. So that's the concept behind that. Subsidies to reduce costs and prices. So that's one thing. Second one is public goods. Public goods like we see street lighting, etc. May not produced in the private sector due to non-rivalry and non-excludability. So such kind of public goods are not at all produced by the private sector. Okay, they are produced by the public sector itself. So state provision of lighting, defense, police force, etc. See, all of them are under the control of public sector, not under the control of private sector. So there, see, it is complete monopoly of the public sector. So we do not see the private forces being there in such kind of thing, because see, these are um, certain basic facilities that are provided to the people in the economy. So in that case, if it is given in the hands of private people, then see, now all this supply demand, all this gets affected by the price. That part of it we have discussed. So in such situation, do they um, take up anything which in a way in which their profit is maximized? So such a things to not happen. Government has absolute control over that sector where these things are provided to the consumers. Third one, we see the third one is demerit goods. Like example is alcohol. See, alcohol is consumed by the people, but there is a negative impact on the health of the consumers. And once the users start using, they get addicted to it. So in such situation, uh, does it happen that the supplier takes undue advantage of that? The supplier, not to take any undue advantage, government also um, intervenes here in the situation. So the supplier has some amount of indirect cost. The more the sales, the more is the indirect tax which is paid on these kind of demerit goods, cigarettes, alcohol, etc. And government has some regulations about how they should be set up these shops and all, how these manufacturing units are there, and what is the way in which they would be supplied to the consumers, etc. Fourth, we see negative externalities. Like if there is an reorganization because of the work that is taken up by them, if there is a negative impact on the environment, then in such situations, there are certain regulations laid out for those organizations, which where they have to comply with all those rules and regulations. So polluters pays policies. There are policies in place. So wherever any organization has any impact on the environment, there are certain regulations, norms which they have to follow, maybe to minimize the pollution or to ensure that the pollution that is extracted from their production processes, certain measures are taken to control that, etc. Okay, so there are policies and procedures, regulations. There are also indirect taxes for such organizations. Large companies abuse their market power. Large company definitely will be the market leader. They will have a major share of the market with them. So with that they can um, they can take undue advantage of their power because they are the market leader. So in such cases, there are certain fair trade policies of the government to control such big organizations, abuses of market power, competition policy, and fair trading regulations. See, the interference with market prices would look like this. See, we know that with the point where the demand and supply meet together is the equilibrium price. So this is the point at which whatever is the price is the equilibrium price. That is the price which is set. Sometimes in certain situations, we see that the price, government sets the minimum prices. The price, this is the price which is optimum. but it can decide a price above the equilibrium price and set that to be as a minimum price to protect suppliers, producers, to fight poverty, creates excess supply, waste, misallocation of resources. Sometimes it can also set the see, unless and until they reach this point, they would not face the equilibrium, but the maximum itself is below that. So there is no way that they will be able to maximize on their profit. But yet the government can decide the price to be below the equilibrium point as the maximum price to protect consumers, control inflation, shortages of supply, misallocation of resources, etc. Okay. So these are the ways in which the government intervenes. So we will be discussing the questions also from the exam kit, so we can have a better idea about that. The next topic here, what we have is economies of scale. Economies of scale. When the scale of operation is on large scale, then in that case, we see that the cost would be economical, economies of scale, increasing returns to scale. Why would that happen? See, as the number of units that are produced increases, we know that the fixed cost is the same from zero number of units till the maximum number of units. So at a point, some point, we see that the fixed cost would be completely absorbed. We call that point to be as break-even point. So beyond the break-even point, there is no more fixed cost which has to be absorbed. So beyond the break-even point, there would be only the variable cost which is incurred. So we see that the possibility of reduced cost happens beyond the break-even point. So as they operate at a scale, at a larger scale, then the overall cost reduces. It is economical in nature. The economies of scale are reductions in unit average cost. So the number of units as they increase, we see that the cost does not increase proportionately. Average cost or average to unit cost will be total cost divided by number of units. As the denominator keeps increasing, the numerator does not increase proportionately. Why? Because fixed cost once incurred would remain the same till the maximum capacity. It does not increase proportionately. On that note, the average unit cost is lesser, or it reduces as they produce more number of units. Are reductions in unit average cost caused by increasing the scale of production in the long run. We see that there are technical, there are internal economies of scale. Some of them are technical, financial, trading, managerial, localized. So as the output keeps increasing, we see that they can get benefit out of the these aspects. First one, technical. Whatever is invested into whatever is invested into technology, see, as they keep producing more and more number of units, see, the cost also is recovered. The investment cost on technology, that would be recovered, and technology, use of technology increases the output because the speed with which the machines are used, etc. That is not anything on par with the human effort. So human beings, when they they operate only for limited number of hours. Their speed is also very low. But when machines are used, Machines operate at great speed. The output, see, they work for longer hours, maybe 24 by 7, sometimes in certain situations. See, the output produced increases. As the output increases, it becomes cost effective. So technical aspect also can provide them some advantage here, economies of scale of saving of cost here. Financial, when they raise funds and then invest in that, see, more number of units that are produced, see, the average financial cost that is paid on these funds that are raised also reduces. Then trading, when they sell more number of units, it becomes economical. Managing the affairs of the business, then again, that also becomes economical. So we see that external economies of scale. External economies of scale, we see the localization part of it. Localization of industry, because they are all concentrated in particular area. So there are certain advantages which they can realize, because they are situated in a particular area, place, and then more number of more amount of activity that happens also can reduce the cost. Okay. Next, we see that there are certain diseconomies of scale, so which means that it does not allow them to minimize or save the cost. The first one is technical diseconomies. Technical diseconomies. See, just now we have discussed that part as economies of scale. The technical part of it, because the output that is produced is more in number, machines can work effectively. The output that is produced is more in quantity, so it becomes cost effective. So production wise, it is cost effective. But the technical aspect of it, to maintain that, see, initially there is huge amount of cost which is to be invested into technical aspect of it, maintenance of these things from time to time, etc. So those are overhead costs which increase with the use of more amount of technology, technical aspect of it. See, then trading, in case of trading also, we see that when the output that is produced is on large scale, um, see, when they produce the output at large scale, basically trading is selling of goods. So when they are produced at large scale, see, the same product is available. The customers are left with no choice. So customer may be looking at a certain variety or changes in the product. See here, the same product, when the production happens, the production is homogeneous. See, the products that are produced are homogeneous. So same standard product is produced and supplied. Now that can result in lack of choice for the um, consumer. So in that case, to convince the consumer to continue to use that product, maybe certain additional efforts would be required. So that can increase their overhead cost. Then we see managerial diseconomies of scale. Um, See, when like we just mentioned that, see, when they start operating, when they manage the affairs of the business, and if it grows, they become market leaders. That's what we have mentioned. They become market leaders. So when they become market leaders, then the power, they get used to that power part of it, and um, so they may not be willing to let go, kind of thing. And since they get used to operating in a particular pattern, they may um, they may not see any changes that are possible to take place. They are already a leader in their respective managerial abilities and all. They become leaders of them. Okay, in that case, so they feel that yes, whatever work they are doing is the standardized work or the best possible thing. They may not be willing to change. So that is a dangerous situation. That may they may look at their work as the best thing, and um, see that kind of a scenario, that kind of a situation is not permissible. See, they may feel that yes, what work we are doing is the best thing. So they may be very self-satisfied. They may not see any changes that are possible to take possible, which can be implemented, etc. So that becomes um, a disadvantage for the organization. So those are diseconomies of scale. So before we get into the next chapter, financial context of business one, before we talk about that, whatever questions we have, we will take it up, answer them. Question number 40. E-commerce generally increases the price elasticity of demand for the products of a particular supplier. Which one of the following statements does not describe a cause of this? A says greater availability of substitutes from a market with more participants. B says generally lower prices due to search engines. C says lower cost of search for alternatives. D says greater focus on price due to e-commerce reducing opportunities for differentiation of services.
Lower prices due to search engines.
It is about the trade commerce happening on the electronic mode. So there are electronic platforms where the buyers and the sellers meet together and then they purchase. See, here we are discussing about increases the price elasticity of demand. So when the price elasticity of demand increases, which means that the change in the price is PED, we see that the numerator has demand and the denominator has price. When there is a demand, when the price changes more than the change in the demand, then we call that as more price elasticity, increased price elasticity of demand. So the price should get affected more than the demand that is arising. When there is a requirement by the customer, there is demand. But the price should get affected more than the change in the demand. The first one says that greater availability of substitutes. See here, price elasticity of demand, we are only discussing the relationship between the quantity demanded and the price of the product. See, substitutes are not a part of this one. Second one says that lower prices due to search engines. We see that happening on e-commerce. See, when the customers keep searching for a product, the following few days we see advertisements relating to that product popping up all over. You must have observed that. See, when that happens, the advertisements, they keep offering more and more options or reduction in price or discount in price. See, the demand is there. There is an increase in demand. The price is drastically reducing, lower prices. So lower prices due to search engines. If this is, when this is increasing, this is even further decreasing. So therefore, the price elasticity of demand increases. So this can be taken. Lower cost of search for alternatives. See, this doesn't have, if we are talking about demand, there is no impact of the price in the third option. Fourth option says a greater focus on price due to e-commerce reducing opportunities for differentiation of services. The differentiation of services is the way the services are provided. Each one of them have a unique way of providing services. So this one is not focusing on the demand part of it. So B is the appropriate. 41. Which of the following goods is most likely to experience large fluctuations in supply due to lag between change in prices and producers responding to that change?
D, wheat.
Motor vehicles, air travel, mobile telephones, and wheat.
Wheat.
Large fluctuations in supply due to lag between change in prices and producers responding to that. See, all of them, whenever there is a requirement, these things can be produced: motor vehicles, air travel, mobile phone, telephones, etc. But agricultural product, it is subject to the season. Okay, so experience large fluctuations in supply. Fluctuations in supply because as and when it is needed, it cannot be. Due to the lag between change in prices and producers responding to that change. On that note, we can go with the this product wheat. A rise in the price of a good accompanied by a fall in the quantity sold would result from decrease in supply, increase in demand, decrease in demand, increase in supply. Price is rising.
Yeah.
Price is rising.
Okay, and there's a fall in quantity. Yeah, decrease in supply.
Would result from
decrease in supply, ma'am.
Why?
Since the prices are rising, even in graph as well, if there is a price in the good and quantity is being sold less.
Quantity sold is less. Quantity sold is less, or the supply when it is low. Okay, less goods are available. The supply is low. The demand will increase. Okay, so then we also see that the price of that rises because see, eventually it will rise because very
supply is low.
supply very less is available. So demand is great for that. Then scarce resources. So decrease in supply. A firm is enjoying economies of scale, then
unit cost is falling as output rises.
it is suffering from excess capacity. It must be a monopoly. Enjoy. It is maximizing profits. Unit cost is falling as output increases. Economies of scale, the cost economizes. So the cost is reduced as the output increases. The main benefit of specialization of labor to a company is that it
raises the productivity.
creates economies of scale, raises the productivity of labor, reduces the boredom involved in manual work. In fact, actually, it increases the boredom, generates productivity. So everybody is assigned with a piece of work. So they work only on that specialized area. The work, complete work, is divided into major parts, division of labor, and each one is assigned one part of it. So they need to focus only on the work which is assigned to them. So as the activity is done again and again, the amount of time that will be required reduces. It's based on the saying which says that practice makes man perfect. So the same work is done again and again. The amount of time which is required reduces. So definitely more can be produced in that time. In that case, this is raises the productivity of labor. 45. Which of the following is an example of an external economy of scale for a business enterprise?
External economy. Locally available train book.
Localization of the industry. Okay. Which of the following are external economies of scale for a business enterprise? External economies of scale. A locally available trained labor force. The presence of a specialist firm providing components. The ability of larger firms to secure cheap bank loans. The development of specialized transport and communication facilities. See, external economies of scale is localization of an industry. See, the concentration of all the associated firms and activities are all concentrated in one area, localization of industry.
Localization of industry.
So in this case, we see that a locally available trade labor force, locally available. So we go with this one. The presence of a specialist firm providing components. Okay. See here, this is a financial aspect, the ability of larger firms to secure cheaper bank loans. This is a financial aspect of it, like a financial economies of scale. Then the development of specialized transport and communication facilities. So we can go with
C, that is 1, 2, and 4.
economies of scale can be gained only by monopoly firms, are possible only if there is a sufficient demand for the product, do not necessarily reduce unit cost of production, depend on the efficiency of the management.
Possible only if there is a sufficient demand.
We are talking about producing at a larger scale. So the choice of producing at larger scale is not available to everyone. See, if they produce more, supply will increase, then that will have an impact on the price, etc., profitability. See, as much as they can sell, only to that extent production will be taken up. See, when there is demand, according to the demand, they can produce more. If there is no demand, they produce more. Then ultimately, to sell all these things, they have to reduce the price, and then it will have an impact on their overall profitability. That part of it is there. So economies of scale concept is possible only when the customers are willing to purchase all that they produce. So there is demand for their product. Which of the following would be an example of merit goods? Merit goods is healthcare, education. Road congestion is
road care comes into public.
we see public goods. Merit goods are healthcare and education and affordable housing. So basic needs which are needed. So 1 and 2 is D. Why are public goods produced in the public sector? They characterized by non-excludability and non-exclusivity. They have high initial capital cost for production. Capital cost. They are examples of natural monopolies. Public goods produced in the public sector.
Non-exclusive.
Not about monopoly. The government is looking at the benefit of the people in the economy. So in that case, we are not discussing about the monopoly. See, initial capital cost, if it is high, we see even the private sector can afford to invest huge costs. But here it is the benefit of the people in the economy. These says their production consumption involves significant external benefits. So here it talks about non-excludability and non-exclusivity. Public goods may not be produced in the private sector due to non-rivalry and non-excludability. So sorry. 50th question says, which of the following is a description of a pure public good? No individual can be excluded from consuming it. When consumed by one person implies less consumption by others. Involves no social cost in production. Is produced by the state. Pure public good.
No individual can be excluded from consuming it.
Because everybody requires examples are street lights, the defense, police force, etc. So no one is excluded from using that. Which is the following? Which of the following will result from a chemical company reducing the level of pollution from its factory? A fall in social cost, a fall in social benefit, a fall in average cost, a fall in marginal cost. A chemical company reducing the level of pollution from its factory.
Fall in social costs. Yeah.
Will result from a chemical company. Will result. Okay. Why would they reduce the level of pollution? Because there is a fall in the social cost. It's not about. See, there are certain measures which have to be taken by the organizations wherein pollution is extracted from their process. So if they are I mean, there are certain regulations levied by the government which they have to comply with. Compliance is very, very important for such organizations. They have to follow certain norms, maybe use certain filters to generate less amount of pollution, etc. So there are compliances on part of the organization which they have to follow. So those are social costs. Because there is a fall in the social cost, they will take extra precautionary measures. So they can afford to increase the those measures to reduce the pollution. See, it is not about benefit. We're not talking about average cost or marginal cost. This is exclusively applicable in case where environmental issues are arising. 52. Which two of the following are examples of merit goods?
Health and education.
Which of the following is not an argument in favor of privatization? A reduction in bureaucracy, a more even distribution of income and wealth, not an argument. Increased competition between firms in the same industry,
More even distribution of income and wealth.
greater consumer choice.
Yeah, since both three are
Distribution, even distribution of income and wealth does not happen because the private sector, their strategies would be to maximize on their profitability. So the rich become more richer in that case. So greater distribution. See, when the government intervenes, then there is a balance in the economy. But if it is exclusively private sector, then there will be no even distribution of income and wealth. So that's why the question says it is not an argument. 54 says which of the following is not a valid economic reason for producing goods and services by the state? It is a merit good, it is a public good, it is a natural monopoly, it is a necessity which is consumed by everyone. Not a valid economic reason. Not, no. So it is
by everyone.
When privatization takes place, assets are transferred from the public sector and money goes to the government. Assets are transferred from the private sector and money goes to the government. Assets are transferred from the private sector and money goes to the private sector.
First one only, ma'am.
Goes to the government. Privatization takes place. See, from the government sector, it moves to the private sector.
Private sector.
Okay, to the private sector. From the public sector, some of them which are under the control of the government, sometimes we see that this privatization of such entities. So suddenly we see that the private players also come into that. So from the public sector, it will be moved to the private sector, but the money goes to the government. From the public sector. The production of good results in a positive externality. Which of the following actions would you recommend the government should take? Give the producer a subsidy that reflects the marginal benefit from the consumption of the good. Positive externality. Recommend. Give the producer a subsidy which reflects the marginal benefit from the consumption of. Give the producer a subsidy which reflects the marginal.
Marginal benefit.
See, when the government intervenes, we have looked into.
Yeah.
When the government intervenes, they set the price which is above the equilibrium price or below the equilibrium price. Here, in this case, they just ensure that the users or the people in the economy are benefited. See, first to talk about a subsidy is given to the producer, which reflect the marginal benefit from the consumption of the good, or which reflects the marginal cost of the externality. Impose a tax on the producer, which reflects the marginal benefit derived from consumption. Impose a tax on the producer, which reflects. Here it is about when they intervene in this and decide set a price which is above the equilibrium price or below the equilibrium price. So they're basically looking at protecting the supplier producers, protect consumers or control inflation. So here the protection of the suppliers is there, where the price is set above the equilibrium price. So it is to here they would find the equilibrium price, but because the supplier has to be protected, they set the price above the equilibrium price. So the producer is given a subsidy, but what's the reason? Which reflects the marginal benefit from the consumer. Okay, so marginal cost of the external. This would be which reflects the marginal benefit from the consumption. So um, when the scenario is that there's a lot of supply is greater than demand, in that case there's a subsidy given or the price is set at a higher level, so that it is to protect the suppliers. So all that they have produced would be consumed by the consumers. So because supply is greater than the demand part of it. So on that note, we can go with A. The government may discourage horizontal mergers in manufacturing industry because, see, merger horizontal, if it is vertical, it is in the supply chain. Horizontal, same type of businesses, see, on the same level, they join together, they merge together. That is called as a horizontal merger. Vertical, see, vertical is this is the vertical image. See, when vertical merger happens, so maybe the supplier is the producer merges with the supplier, or the consumer the customer merges with the producer or something like that. That is a vertical merger. Horizontal, it is the same level. Okay, so the government may discourage. Main thing why they discourage is that they may become a powerful force. See, all of them on par. See, when they are on par, they become one. they join together, so that becomes a bigger organization. When that is a bigger organization, they become powerful leaders and kind of a monopoly, and they can decide the terms and conditions for the market. So that the government doesn't want. So it discourages horizontal mergers from happening. By controlling the source of supply, the merged firms will have unfair advantage over its rivals. The merged firms will be unable to secure economies of scale. Consumers may lose out if the merged firm acquires market dominance. There is a lack of synergy between the two companies. The best thing is C, because they become a powerful force in the market. Then they start dictating terms for the market. So consumers may lose out. They will decide what should be the price, etc. There are various other things which the monopoly decides. In that case, the consumers will lose on that. Okay, therefore, C would be the appropriate one. 58. And so three more questions are there before we start with the next topic. Which of the following is not a tool that government can use to attempt to stabilize markets? Not a tool that government can use. Setting minimum prices, providing guaranteed minimum income for producers in the market, preventing overproduction through set aside payments, setting a minimum wage. The producers, the question talks about not a tool that government can use to attempt to stabilize markets. Stabilize markets is to do with the producers, to do with the consumers, how they are benefited. Minimum wage is an aspect about the employees in the organization, setting a minimum wage. See, that is a regulation which benefits the employees. So,
it's D only then.
because it's not a tool, no?
Yeah.
Which one of the following best describes the main purposes of organization, such as the Competition Commission in the UK? To prevent the growth of large firms, to investigate anti-competitive behavior by firms, to encourage mergers to enable firms to secure economies of scale, to regulate the prices charged by the privatized utilities. To prevent the growth of large firms, no business, no government will think about it. Growth of large firms, to prevent that. To investigate anti-competitive behavior by, see, here in India also we have certain laws to ensure that there are no unfair trade practices happening. Here also, investigate any anti-competitive behavior by firms. To encourage mergers, see, if mergers happen, then they become a powerful force. So there is no kind of an encouragement here. To regulate the price charged by privatized utilities. See, only in situations where there is a need to intervene, the government intervenes. Otherwise, it is not regularly looking into what the prices are charged by the suppliers. 60 says, which one of the following would be a sound economic reason for a government to prevent a merger between two companies? The merger between two companies, the only reason is they would become powerful, and then they become dominant in the market, and then be involved with any kind of unfair trade practices. So that should not happen. Okay. Combined profit would increase. Here, one of the following is the sound economic reason for a government to prevent.
Competition would decrease and price would rise.
Definitely, there is no,
There will be choices.
because they have already joined together. Competition reduces, they become the leaders or they become monopoly. They decide the prices. They set high prices here. Okay. We'll go to the next topic. The mood of the next topic will now change. What's the financial context of business? One. Okay. We would be looking into what is the requirement of financial aspects in an organization is what we will be looking into. Just take a break for 2 minutes, because from that core economics we will be coming to here as business economics, or mostly to do with the financial aspect of the organization. So just we'll break for 2 minutes, 2-3 minutes, and then we'll continue.
Well, okay. Yes, ma'am.
The next chapter, the next topic is financial context of a businessman. So it says every organization has its own requirements. So to meet the requirements of the organization, funds are raised from different sources. See, funds which are required here. The first one says that organization has short, medium, and long-term financial needs. See, long-term needs are to invest into the business. So invest into projects, assets, purchase of assets, investment into projects to ensure that the business activity is carried on. So funds which are raised for a long period of time. See, when the funds are raised, they are invested with the condition that the funds which are raised will not be repaid back to the investor in the short period of time. So they are held with the business for a very long period of time. So there are sources which are used to raise the funds, like the equity capital, long-term debt capital, etc. So such kind of sources from which the funds are raised. These funds are invested into the business, and the investor also understands that the amounts will not be paid back to them, or the funds will not be repaid back to them in the short period of time. Then medium term, arising from costs and payments in the longer term contracts and production process. So see, for the period is a medium period, not a very short period. Short period is to meet their immediate requirements. See, certain payments have to be made from time to time. So they have to meet the payment to the creditors. They have to meet all the operating expenses like wages, salary, every item what we can see in the P&L account, trading account. So to purchase material, pay to the supplier, make the payment of wages, all kind of operating expenses, salaries, printing stationery, whatever charges are there. See, that is all in the short run. See, these things have to be met. If they are not met in the short run, promptly the reputation of the business gets affected. So short run is for a very short period of time. So they may approach the financial institutions, banks, and all other sources with the promise that these things would be repaid in the short period of time. So anything between the short period of time and the long period of time is the medium term period, arising from costs and payments in the longer term contract. So maybe to meet the payments, or to pay the cost of capital to the investors, or maybe additional funds are needed to be invested into the long term projects, etc. So those are medium term needs. Okay, financial needs of individuals. Individuals may have liquidity surpluses and deficits. So the basic concept of business entity concept what we have learned, we understand that business is separate from owner. So owner as such, business as such does not have anything of its own. So the funds are invested by the owner into the business. So business receives funds. These funds with which the business is commenced. So the capital amount, when owner invests that, then there is a separate entity, owner becomes different from the business. See, it's only about the owner investing funds into the business, the funds with which the business starts taking decisions. So it invests into long-term assets like plant, machinery, etc., investment into projects, etc., so that some cash flows can be generated. Okay. Then, as such, business does not have anything. Then, with this um, um, activities like generating cash flows and all would be taken up. So we see that periodically there is some amount of revenue generated. Then out of that, some amount of payments are made, operating expenses are met, cost of capital is met, etc. So there could be a surplus sometimes, maybe where the revenue is more than the expenses. Surplus could be there, or sometimes the revenue is not sufficient for that period to meet all its expenses. So there is a possibility of a deficit also. These funds are invested into activities. From the investment, the sources of revenue are generated. So revenue, out of the revenue, the expenses are met, but not always necessary that the revenue generated is sufficient enough to meet all the expenses. So it could be a surplus scenario, it could be a deficit scenario also. The short run income normally arrives monthly, but expenditure is continuous. Okay. There could be fluctuations in the income. That is what it means to say. Sometimes the sales could be varying, fluctuating. So revenue could be fluctuating, but expenses are consistently there all the time. Therefore, we see that there is a surplus or a deficit. The medium term expenditure has peaks. Example, Christmas and holiday periods, and lows at other times of the year, seasonally, when the expenditure increases, because the activity increases, expenditure also increases. Also, purchases of consumer durables like cars raises medium term liquidity problems. Then the long term requirement, the long term financial needs are especially for the purchase of houses. See, from the consumer's point of view, if we are talking about individuals, if it is individuals, one second. See, from the individual's point of view, individuals may have liquidity surpluses when their revenue increases. Then there is surplus. Otherwise, there is deficit. Then, in the short run, income normally arrives monthly, but expenditure is continuous. Monthly, medium term, seasonally, when they have to spend more, then their expenses increase. So there is a deficit during that period. Then long term, where they tie up their funds in purchase of assets, houses, motor vehicles, etc. So especially for purchase of houses. Then we see financial needs of governments. Financial needs of governments. The government's current expenditure is steady over the year, but tax revenue is not. Hence, short-term liquidity shortages and surplus. For them, it is recurring. It is periodically they earn this tax revenue. If there are fluctuations in tax revenue, then they may see deficit. Governments undertake longer term projects, including public investment, which have to be financed in the longer term. So in the long run, government must manage the national debt. This is accumulated government debt resulting from previous borrowing. So we see that there is a situation of arising about surplus or deficit from organization's point of view, from individual's point of view, from government's point of view. Every entity, whether it is an organization or an individual or government, they have their sources of revenue and they have their means how they spend these amounts. So there is expenditure of these entities. See, there are periods where the revenues are high. There are periods where expenses are high. On account of that, there is a surplus situation or a deficit that may arise. Okay. Now we will be looking into what are the finances for businesses. So what kind of finances can be raised by the business? First, we see finance for businesses. Business, when it requires funds, see these funds are raised by what sources? For a business, the source of finance are, first one, it says that internally generated funds. Then second one, equity generated funds. And third one is debt finance. So broadly speaking, there are two main sources of finance for organization. One is from the owner's side, the funds that are raised. See, we have equity. Then we have from the external sources, the funds that are raised, which we call it as debt. There are basically, broadly speaking, there are two different types of sources. See, owners investing in the funds, like we see for a sole trader, the owner, which is wherein he invests the amount, it is the capital amount. For a partnership, partners investing their amount of partners capital. In case of a company, joint stock company, we see that the share capital which is raised, it could be preference share capital, equity share capital, whatever it is. See, that is owners' funds invested in the business. You also see that debt outsiders also invest their funds. Outsiders like loans are taken from banks, loans are taken from financial institutions, or they can also go in for issuing of bonds or debentures or something. See, these are all external sources from which the finances are raised, equity capital and debt capital. Okay, the other day, when I was taking you through the income statement format, you must be remembering that. See, after the equity dividend is paid, the amount which is undistributed, which is retained in the business, is called as retained earnings. Technically speaking, that is the amount of profit available to ordinary equity shareholders reinvested in the business. So that is also a form of equity capital only. So broadly speaking, there are two different types of capital, equity capital and debt capital. So here it says that internally generated funds, which are retained earnings, are reinvested in the business. So used for reinvestment, used for any type of contingency to be met in the future. So there are funds which are retained in the business. Then there are funds which are raised from the owners. So in case of a company, preference shareholders invest in the firm, equity, ordinary equity shareholders invest in the firm. So all of them are equity capital. From outsiders, that is banks, financial institutions, or debt holders like debenture holders or bond holders, etc. When funds are raised, we call that as debt capital. Each one of them have their own attributes and features. we will be discussing in a short while. See, what are the sources? See, when these funds are raised and invested, there is no expectation which the investors have that, or there is no obligation for the business to repay these amounts in the short period of time. They would be there with the business for a very long period of time. The share capital, the concept of repaying of share capital never arises unless and until the company exists. Only on winding up of the company, the amounts are repaid to the shareholders. We know that part of it. So forever, they are there in the company, they are irredeemable. Okay. Then we see, in case of debt capital is also raised for a very long period of time. They are repayable, they are redeemable, but that redemption period is not in the short period of time. So they are raised for long period of time. Then what are the sources of finance that can be raised for short period of time? See, short period, what is the requirement? Requirement is to meet their operating expenses, to make the payment to the suppliers, to meet all their operating expenses. We see funds are required. Basically, working capital requirements to meet that, any funds which are needed, we call that as short-term requirement. Okay. For organizations and individuals, financial needs can be met by the banking system and money market. So they can borrow it from the banks, or we have a market called as money market. Money market and capital market, one classification of markets in the financial system. We see that one type of market is money market, wherein the transaction, wherein the financial instruments are issued for a period less for 1 year or less than 1 year. So the time period, the classification is based on time period. So if the time period is less than 1 year, we call that market to be as money market. So the instruments are repaid back in a period less than 1 year. Okay, so that is a money market where there is buying and selling of financial instruments happen. The time period being 1 year. But if the time period is more than 1 year, if there is sale of financial instruments, the securities, buying and securities happen, which for a long period of time, okay, not with an intention not to repay in a period less than 1 year. So such kind of a market is called as capital market. So stock market is a capital market. Okay, so they meet their requirements for short period of time from the banking system, from banks, and from the money markets. So they deal in short-term financial instruments, including cash, current accounts, overdrafts, and short-term loans, certificate of deposit. We will be looking into all these instruments: certificate of deposits, bills of exchange, trade credit. The main providers of the short-term finance are commercial banks, finance houses, and other companies. The trade credit is when credit is extended by the supplier to the manufacturer. We call that to be as trade credit. To trade is buying and selling. See, when the credit is extended by the supplier in terms of buying the raw material, we call that to be as trade credit. Bills of exchange, when the transaction takes place on trade, that is buying and selling, happens on credit basis. See, the trade happens on credit basis. In such cases, when the trade happens on credit basis, the possibility of a bad debt arising also rises. Okay, so when the goods are sold to the customers, so the customers may not pay. Goods are sold to the customers on credit basis. At the end of the credit period, the customers may not pay. Similarly, when the supplier is extending credit period to the manufacturer, at the end of the credit period, the manufacturer also may not pay promptly to the supplier. Now, if that is the situation, there is a possibility of a bad debt arising. When there are bad debts, it is a loss for the business. So, to ensure that the bad debts do not happen, um, see the seller draws a bill on the buyer, and the buyer accepts the bill um, and signs on that. So that way, when they enter into that agreement, it is legally binding. So on the due date, when the um, payments are not made by the buyer promptly, then the seller will always have an option to take a legal action against the buyer. That is called as bills of exchange. Certificates of deposits, we will be discussing certificates of deposit, CDs, what we call it as. These are issued by the organizations. Certificate of deposits are issued by the organization for a stipulated period of time. See, for a period of time, but that is less than 1 year. For different time periods, these certificate of deposits are sold by the organization. So when they sell them, the investors buy the certificate of deposits. At the end of the time period, the amount is repaid back to the investors along with the interest rate. Okay, so that is certificate of deposits. So overdraft is a facility extended by the bank to withdraw more than what they have deposited in the bank. Overdrafts or taking short-term loans. The current accounts, where the number of transactions that are taken up by the businessman, definitely they are more. So instead of going ahead with the savings account, they are allowed to open a current account wherein the number of transactions that they can take up during a particular period are more in number. See, there are certain other benefits also which are associated with current accounts, or they can meet the short-term requirements with the cash balances that are available with them, the amount of cash available in the cash box or cash in bank. Okay. Main providers of short-term finance are commercial banks, finance houses, housing companies would be providing, and other companies. Okay, so here we will see what are the different financial products. So let's discuss broadly speaking. As I mentioned that um, equity is one type of capital invested for long-term period, and the other one is debt capital. Here it is very specifically given as bonds. See, the debt capital is raised in the form of bonds. So what we are very well accustomed with the term called as debentures. Debenture is one type of bond. So that's the same meaning there. From a company's point of view, from an organization point of view, see, if the organization is raising equity capital, it is raising debt capital. What attributes are there with equity capital? Equity capital is irredeemable, all as you all know already, since you've learned financial accounting. See, equity capital is irredeemable. So as long as the company exists, the capital would be there with the company. Okay, there is no repaying back of this equity capital during the lifetime. So the organization can take decisions very comfortably because there is no pressure on the organization side to repay the amount in the short run. That situation is not there. But the owners always have a high expectation from the company that the company earns better returns for them and better dividends are available for them. The other day, as we were discussing about EPS and then dividend yield, earnings yield, I did mention that, see, the amount of earnings that are made, the amount of dividends that are paid definitely has an impact on the market price of share. So then there is so there we see that there is an obligation, there is a risk aspect which is involved um, um, in terms of paying higher cost of capital to the equity holders. So the obligation is to earn better returns, But the assurance for the organization is that they need not repay back to the investors as long as the company exists. In case of bonds, see, on the other hand, bonds or debt capital has a time period, even if it is a long period, let's say 10 years, 15 years, 20 years, no matter what it is, even if it is for a long period, there is a time period, there is a maturity period. At the end of the maturity period, the amount has to be repaid back to the debt holders. Okay, that's one thing. So for the organization, it is a risk because they have to repay their amount. See, all the funds that are raised are already invested into the different projects and assets and all. Funds are not available. The day when the funds have to be repaid back to the um, debt holders, then they have to again find another source of capital to repay that. Second, see, there is an obligation to pay return on the bonds. Interest on bonds has to be paid, irrespective of their profitability. See, when profits are not available, also interest has to be paid. So is not the case with the equity. Only when profits are available, dividends are distributed. The ordinary equity shareholders, as we have discussed the other day, sometimes situations that there is no amount of dividend distributed to equity shareholders. All the profit available could be retained by the organization. So these points we have to remember very clearly from organization point of view. Okay. But what about from the investors' point of view? Investors' point of view. See, in case of equity, risk is very low for the organization because they don't have to repay repay them back in the during the lifetime. But always there is high expectation from the investors to pay better returns. So they are under an obligation to earn better returns. I hope you are clear with this. In case of bonds, there is risk is high because irrespective of profitability, interest has to be paid. There is a maturity period. But the advantage of raising debt capital is, see, it is cheaper form of capital. Very less amount of interest as compared to dividends will be paid. There is a fixed percentage which is agreed. Year after year, the same amount of interest amount is paid to the investors. Plus, interest is a tax deductible expense. So, because interest is paid, their tax burden also reduces. So, these are the points from the organization point of view. Then we also have to look into from the investors point of view. So, equity. It says that in case of equity, the returns are potentially very high. Why? This is from the individual point of view. Why are they very high? They are very high because the expectation of the shareholders is always there. To meet the expectation of the shareholders, the company performs better, earns more returns, and pays better dividends to the shareholders. Period after period, there is an increase in the amount of dividends paid to the shareholders. What's the consequence if they do not do so? There is a possibility of they withdrawing their share capital from the company. So that is a risk which is there, always present. Okay. So from the investors' point of view, their profits are really very high. Okay. So potentially very high returns if the company is profitable. What if the company is not profitable? In the equal measures, their returns are also at a risk. The only when profits are available, dividends are paid. When profits are not available, dividends are not paid. So that is the concept here. What we see, returns are potentially very high if the company is profitable. Risk. What are the risks? Shares carry high risk for the investor if company profits fall. We see as the profits fall, the company is not under any obligation to make any dividend payment. Only when profits are available. So the returns are high, the risk is also very high. The years when profits are available, returns are high. When profits are not available, no dividends are paid. So risk is also high. Then time scales. The company usually has no intention of buying back the shares, so equity is considered long term. So the investor once invests, it is held up by the company. The company will not pay back their amount. Only one alternative is that they can sell their shares in the stock market. That facility is there. Okay. Certain clauses where the company always also buys back its own shares. So some other context we can discuss about what is buying back of the shares. But otherwise, the company is under absolutely no obligation to pay the investment amount, share amount back to the shareholders. Liquidity. For unquoted companies, it is very difficult to sell the shares. But for quoted companies, the shares are highly liquid, so investors can cash in at any point of time. So if they are quoted, they are listed in the stock market, easy to sell them. But otherwise, it's difficult to sell these shares. So share transferability is always there, but it is subject to whether it is easy or difficult. Bonds, on the other hand, we are looking into from the investor's point of view. Returns, typically bonds have low returns because they are a lower risk investment for the investors, because investors are assured a fixed percentage of interest period after period. It is not subject to the profitability situation. But in case of equity, it is all subject to profitability. When profits are available, dividends are paid. When they are not available, no dividends. But here, in case of bonds, irrespective of whether there is profit or not, interest has to be paid. So they are at a lower percentage. They are definitely not at a higher percentage. So returns are low. Risk is also low because they they will be paid some amount of return. Their interest amount will be paid. Their investment amount also is repaid. Risk, bonds are usually lower risk than equity for the investors. For example, the bonds may be secured and the interest rate is fixed. Then time scales, the maturity is defined on the bond and varies from very short term. If it is very short term debt instruments, it could be treasury bills of a very short period of time, as low as 14 days. See, very short period of time to very long period of time, let's say 25 years corporate bond. See, depending on the requirement, the bond amount is raised or the debt amount is raised. Some bonds are redeemable, but others are irredeemable. We see very rarely that irredeemable bonds are issued by the company. Investors generally expect a redemption period, but we also see that there are in certain rare situations, there are irredeemable bonds also issued. In terms of liquidity, bonds are unquoted, then the investor has no choice except to wait for the redemption. So selling again in the securities market may not be a possibility. However, if quoted, then they will be easier to liquidate. So then they can easily sell it in the securities market. For example, government bonds are usually very liquid. So whenever they require funds, they can sell them back and then get back their amount. To continue with the other financial products, first one, certificate of deposits. Here, see these returns, very low returns due to low risk, very safe because there is stipulated time period. At the end of the time period, the amount is repaid back. and the return for the investor also, it is very low. So it is comfort. So if they have some surplus amount where they do not want to block it in long term investment for short term period, if they want to invest their funds for a short period of time, so CD is one best use. Okay. um, on these CDs the return is very low returns due to low risk, very safe, because there is a time period at the end of which the amounts are paid back. Okay, 3 and 6 months maturities are the most common, but other than that, we also see 270 days also. The time period on certificate of deposits. Liquidity can be easily sold on money markets. After that, we see mortgages. Mortgages where the asset is mortgaged with the financial institution. As against that asset, some amount of loan is raised. So the asset will be used as a collateral. As against that asset, the loan is repaid. What if in case the loan amount is not repaid promptly? Then this asset can be used to recover their loan amount. So that's a mortgage. Okay. The returns low as the mortgage will be secured on the property bought. Risk, as stated, usually considered low risk. Why? Because even if the borrower does not make the payment, also there is an asset which is used as security or a collateral that can be used to recover their investment amount. Risk, as stated, usually considered low risk. However, a fall in the house prices would reduce the value of security offered. Time scales long term. Generally, it is long term, anything between 10 years to 35 years. Then, if it is liquidity issue, the traditional position was that the mortgage could not be resold by the lender to recover their funds. Note, see, as long as it is mortgage, the owner of the property will not be able to sell it again to someone else unless and until the loan that is raised against the mortgage or against the property, unless and until it is settled up, it the the owner will not be in a position to resell it or sell it to anyone else. That is the issue with liquidity. Then we see credit agreements. What are credit agreements? So the credit facility that is extended to the investors by way of credit cards, etc. So some credit facility which is extended by financial institutions, um, credit cards or some kind of line of credit, etc. So those facilities are extended by financial institutions to individuals, organizations, so that they can meet their capital requirements or fund requirement of funds out of these credit agreements or arrangements. Returns for the issuer is usually very high interest rates. For example, store cards typically cost around 20 to 25 to 30% per annum. We see that credit cards also, if the payment is not made, see the interest charges that are levied are very high. Okay, the risk is the credit card company faces the risk of default as the returns are high for the company. See, the cost for the individuals is very high because they have to pay very high interest rates. For the company's point of view, the returns are very high, very attractive because the interest rates are very high. At the same time, the risk is also very high because on the credit cards, we see that default payments would arise. So when they default on the payments, it is a loss for the company. So that situation is there where returns are very high, risk is also very high. Risk, the credit card company faces the risk of default, that the cardholder will not repay the amount borrowed, as such cards are usually unsecured. Time scales usually short term, although some individuals can get into financial difficulties by running up large debts on credit cards that they cannot repay. The liquidity part of it, the debt cannot be resold by the lender, but the borrower may be able to repay early funds permit. So if debt facility is given, this debt facility, like in case of bills of exchange, the bills of exchange um, can be discounted with the financial institution, with the bank, by the drawer. The drawer can discount it. See, any kind of asset like accounts receivable, that also can be factored with some other entity. But the credit facility that is extended by the bank or financial institution, that cannot be resold. They have to wait until the user himself makes the payment. So the debt cannot be resold by the lender, but the borrower may be able to repay early if funds permit. So if, let's say, if they have raised the funds for a stipulated period of time, let's say for 6 months, before 6 months, if the funds are available, he will be in a position to repay that amount. Then bills of exchange. Bills of exchange returns difference between buy, sell price and redemption value. Risk is may be guaranteed by banks. Time scale, because they enter into this agreement, so legal action can be taken, so that security would be there. Risk may be guaranteed by banks. Time scales, we see short term, that is time period between 3 to 6 months. Liquidity can be resold on money market. So these bills of exchange, the bills which are drawn on the drawee, the drawer can discount them with others, or it is like they are transferring this asset to someone else, as against which they can collect the amount. So that is sale of bills of exchange. Any doubts until now? Any doubts, Kavya? Will we answer the questions, Kavya?
Yes, ma'am. I was reading the question itself. 60%.
Indicate by
Yeah.
clicking the appropriate box whether the following statements are true or false. Coupon bearing
No,
securities have a fixed maturity and a specified coupon bearing. Coupon is interest. See, on the securities, if there is a coupon which is attached, or there is the title of the security has a coupon or an interest rate within the title, coupon bearing securities. They have a, see, interest is paid on debt capital. Debt capital has a maturity period and a specified rate of interest. So it is true. Which three of the following are key roles played by money markets? Money market is for a short period of time. The period of time is 1 year. Okay. So which three? Three have to be selected out.
First three as well. First three.
Providing short-term
ABC.
liquidity to companies, banks, and public sector. Short-term, no? So
Short term,
short
yeah.
term. On that note, this can be selected. Provide short-term trade finance, allowing an organization to manage its exposure to foreign currency risk and interest rate risk. Last one, dealing in long-term funds. So long-term is not the attribute of money market. So in that note, we go with which of the following are money market instruments? Certificate of deposit, CDs, corporate
The bond, the first three papers, treasury bill and certificate of deposit as well.
corporate bonds. Then we see commercial paper.
Commercial paper and yeah. C option.
Only this is for long term. Corporate bonds
Yeah.
is for long term.
Bonds.
1, 3, and 4. Which of the following is the difference between primary and a secondary market? For the first time, when securities are issued, they are issued in a primary market. When the securities are traded a second time, they are traded in the secondary market, primary and secondary. Which of the following is the difference between primary and a secondary capital market?
First one only, ma'am. Primary market,
relates
sale of
to new
securities and
securities. Secondary capital markets are securities after their initial.
after initial payment. Yeah.
Which three of the following are true in relation to certificate of deposit? They are evidence of a deposit with an issuing bank. They are not negotiable and therefore unattractive to the depositor as they do not. We'll do this part of it tomorrow. Because let's look into the attributes of certificate of deposits in detail. So basically, outline part of it we've learned, but the question talks about what attributes are there of certificate of deposit. So once we do that, we can take up this question 65. If the central bank raised interest rates, the most likely outcome on the stock market would be interest rates are raised. So what's the consequence of that? Consequence of that would be the investors will go for investing into debt capital. Banks have raised interest rates, so interest rates are much attractive. So the investors will look at debt capital as more attractive. See, debt for the investor is less risky because they get back their amount promptly at the time of interest payment and also at the time of repayment, redemption time also they get. For them, risk is low. Along with risk is low, interest rate is also very attractive. Their attitude will be towards the debt capital. So shares are not very attractive. So the demand for shares will fall.
Don't know.
When the demand for shares fall, the price of the shares also fall. There is a direct relationship between the price and the demand for shares. It is an exception to the law of demand. So there would be a fall in the share price.
Yes, ma'am.
If a central bank pursues If a central bank pursues an expansionary open market operations policy, it would carry out which of the following? Sell securities on the open market, buy securities from non-government holders, increase the reverse asset ratio.
Buy securities. Since expansion is possible through buying only.
Expansionary open market operation policy. They're
Yes.
considering expanding their activities. It will carry out, they will buy securities from non-government holders. B would be, but I
Buy
think I
securities.
should be talk more about banking sector before we can take up these questions. I think
Yeah, but it is
we will take up some more
unlimited
content and then
international norm.
we'll answer this.
Yes.
Logic will be then more clearer for us. So
Yeah.
maybe 70 we can take it up because it's redeemable bond. We'll just do 70 and then wind it up. ABC
Okay.
company has made a new issue of redeemable bonds. If the market rate of interest rate falls, how will the price of the bonds react? See, these are bonds, redeemable bonds. If the market rate of interest falls,
It will increase the price of bonds.
then in
Since
that case, what happens? See,
yeah,
these are bonds with high interest rate. Bonds have high interest
yeah,
rate. Interest rate is high. Then as of now in the market, interest rate is very low. So they have fallen. So the other opportunities in the market are not attractive. But here, bonds which are already issued, we are paying better interest rate. And this is once it is fixed, it will be the same until the redemption time. It will be the same interest rate. So other investors from the market, they will now, because the interest rate is low here, so they will move from the other sources to investing into the bonds. So bonds which are saleable in the securities market, other investors will come forward to purchase these bonds. So the demand for this, how will the price of the bonds react when the demand for these bonds increase? When the demand increases, the price also increases.
rise. Yes.
Okay.
Yes. Yes.
So then let's wind up here. We'll meet tomorrow. Okay.
Yes, ma'am.
Continue further.
Okay, ma'am. Thank you, ma'am. Bye.
Bye.